While I'm shooting this video in late February 2025, the principles I'm about to walk you through apply no matter what time of the year it is and no matter who is in the White House. Currently, we're hearing talk about abolishing the IRS and increasing our reliance on tariffs to fund our federal government. We're also laying off massive numbers of federal employees, and there's all kinds of other reasons why some would be quote unquote bearish. I would first, before going any further, point you to our investment philosophy. In general, we have studied history and we have become convinced that there is enough evidence to suggest that the stock market here in the United States does indeed experience prolonged bear markets or prolonged negative environments, and every bear market starts as a minor pullback. The second principle is we don't know which way the market is going. And finally, that leads us to the final conclusion. We have to have a plan on how we're going to manage our client assets no matter what is happening, whether the market's moving up or the market is moving down. So again, I'm shooting this video on Monday, February 24th, and on the screen is the Russell 2000 from Friday, February 21st. And you can see that it was a really bad day for the Russell 2000 or the small cap sector. And the question is this a sign of an overall not healthy stock market, or is it just seasonal weakness? If we look at the Russell 3000, which is what we use to look at the overall breadth of the stock market because it captures about 95% of the United States stock market, we can see that the price action was halted at a short-term support. That's good news. The bad news is the evidence suggests that we have more declining stocks than we have advancing stocks, and that is definitely not a sign of a healthy stock market. We look at the seasonality chart and we see that February is historically a pretty tough month, but this February is already pretty negative and we still have a week to go. Even though February is typically bad and March is typically good, that doesn't mean it's going to happen. We could also argue that the first year of a presidential term is typically pretty good, but that doesn't mean it's going to happen. From a bearish point of view, we could argue that abolishing the IRS and shifting to 100% reliance on tariffs might cause a very large upheaval in the economy, and therefore it's bearish. The stock market's going to go down and we're going to have a recession. We could also argue that the government is laying off lots of employees and all those employees are going to hit the unemployment line, and that's also going to cause a recession. Again, the reality, guys, is we do not know which way the market is going to go. We follow price. We don't make decisions based upon what we think is going to happen. We follow the price and we execute our strategy as active portfolio managers. We're looking at this every single day and we're making tactical adjustments so that if the short-term pullback turns into a bear market that nobody thought about or that nobody thought was coming, we've already taken action. If we've taken action and protected principal, but the market recovers in March like it typically does, well, we take action again. That's the job of an active portfolio manager. Let me know if you have any questions.